All right, welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe. Very excited for today's show. We've got Craig McGrouther from Lone Star Capital, and super excited to get him on. We had Craig, we had Rob Beardsley on this podcast before, so very excited to get you on and hear your story. So that's it. How's it going?
Everything is amazing. It's a pleasure to be here, to be amongst all the great guests you've had, and just an honor to speak here to talk about something that we love, obviously, mutually, which is talking real estate and multifamily real estate. So excited to be here, and let's let the show rip.
Let's do it. So you told me before we hit the record button, you're in the Phoenix area. So make me a little bit jealous before we get going. Tell me about the temperature there. How warm is it?
Let me tell you something. It is now the time of year where it is warm enough in the morning where I don't have to drive to my indoor track in my gym to work out. I can waltz out of my house at around 6:30, 7
Yeah,
a.m. and maybe have a little long sleeve on, something like that, and I can run. So it's good. So right now, it's the
lovely.
most beautiful time of the year. I would argue that March is better than November here, but
Mhm.
it is the best. It's like mid 70s all day,
Oh
no
yeah,
clouds in the sky, none of that. So it really is a beaut here right now.
perfect. I took advantage of it. I was at Raise Fest. We saw each other in passing, but I did go rent a road bike and did put a good 40 miles out. So
Good for
went up in
you.
the hills around Scottsdale, and I was loving the temperature. It was nice. So anyway, I'm in Idaho Falls. It's about 26 degrees here, and you can't go outside for a long run with shorts and a long sleeve tee right now. So
Yeah.
we're getting there, but that's June here. Anyway, so let's talk a little bit about you, your background. So tell me, how you got into real estate first of all, and then eventually we're going to get into how you got into this multifamily game.
Yeah, absolutely. Well, it's kind of a funny and unique situation with my personal story.
Mhm.
I, for whatever reason, came out of the womb wanting to sell homes. I don't know
Mhm.
why. I wanted to be a residential real estate agent,
Yeah.
but I never thought I was physically gifted enough or good enough to be a professional athlete. That dream was never a dream of mine. It never just felt realistic nor tangible. And for
Yep.
some reason, I always wanted to make a lot of money. I knew that
Yep.
when I was really young, which is, I don't know if it's an obscure thought or if people really thought that way. I don't know if
Mhm.
that was just hardwired into me, just hearing my dad talk as he's a financial
Yeah.
advisor, or if I just saw that I wanted nice things or just expected a lot of myself, but I wanted to make a lot of money.
Yeah.
And being a dyslexic person, it's like, well, I could probably sell houses. It just made a lot of sense to me. So
Yeah.
that goal really never deviated, as funny as that sounds.
Yeah.
So as a kid, I would be watching Sports Center, ESPN, and then HGTV home flipping shows.
Yeah.
Bizarre combination, but the combination is what it was. And eventually graduated from the University of Arizona.
Cool.
And then I started selling houses. And then it wasn't until, 2018, I really started developing a relationship with Rob Beardsley, the principal and founder of Lone Star Capital, as we're from the
Mhm.
same basically hometown back in the Bay Area.
Mhm.
We had a connection, we had some mutual friends, didn't think much of it. The summer of 2020 occurred. Obviously, COVID was not the most fun place for those who were residents in New York, but Phoenix was a little bit more open at that point. So
Mhm.
Rob came to visit, actually, my roommate and I, but really more my roommate. He stayed for what we thought was going to be 3 weeks and ended up staying out in the heart of the summer, which was, by the way, the hottest summer I can ever recall in
Yeah.
Phoenix for 3 months. And we just hit it off. We're talking about real estate every single day. And
Mhm.
I think it was a couple years, maybe a year later. I was like, I think at some point it'd be great if we work together. I think there'd be a nice fit here. So real estate was always the goal, but
Mhm.
multifamily, I kind of fell on butt backwards, as they say. So that is in
Yeah.
fact the story there, but no looking back. And I'm very grateful to be in the position I'm in right now with the incredible partners and community we have. And that's really one thing that I'm sure you can appreciate too,
Yeah.
Brian, is just how great of a community and get people we get to work with and, the colleagues and such, not only about, just the people and the space and the business, but who we get to partner with, whether it be co-GPs or fund managers or, institutional equity partners. And then of course our investors. So I just feel so grateful, so happy to be in the position I'm in right now where, Lone Star is really humming along and doing very nicely in the cycle, which a lot of people unfortunately, don't want to dance at anyone's graves, but can't say right now. So it feels really
Yes.
great that we can play offense in a time where a lot of people have to play defense and are raising money for, cash calls and capital calls as opposed to buying new
Mhm.
opportunities is what we're doing right now.
Yeah. Yeah. And I was very fortunate. We had a local credit union, and when I first started, I was doing deals in like the Carolinas and Georgia. I'm now in Salt Lake City area, but we had a local credit union in South Carolina that was giving us bridge type loans with fixed rates, and so, looking back at it, because of that credit union, we didn't have any of the debt that's going bad for a lot of people right now. And so, yeah, I'm in the same spot. I spent last year trying to play as much offense as possible, buy as many properties as possible, and started 2024 with the same mindset of, let's just keep buying, let's keep doing this.
Yeah,
So
and we were chatting before line too because you mentioned that you're really reinvigorated with what you're doing. You're kind of, I guess, not restarting, but retooling and kind of in the process of the ascent. And it feels so good to be on the right side of this, being able to play offense right now, be able to take advantage of some real discounts, which, we obviously know, very rarely in the cycle do we actually get a true and legitimate opportunity to pick up opportunities that are a lot more discounted than what the normal
mhm.
pricing is, especially with how competitive the space has gone. Because if you were in the industry 20 years ago, not that I was there, but the institutions have been in the game now, which has kind of compressed the numbers, which, protects the downside of the deal, but also limits some of the upside in the alpha in the investment vehicle.
Yeah. And just throwing numbers behind that, I mean, we just bought a property at 10 million that 13 million is what it appraised for 3 years ago, and we assume their loan, and that's the appraised value when they got the loan. And, we're buying another property right now where their all-in costs are at 13.6, and, we offered 12.9. So, I mean, you start looking at you look at the numbers and the dynamics. I mean, we're probably at a 25 to 30% discount in Salt Lake City off of the high point. And so,
Which is one of the hottest and best and most robust markets.
oh
So
yeah,
stable, good demographics coming in, tech coming in, obviously to Salt Lake City. This isn't a, I can't, it's hard even to say emerging market because it's already
3
developed and
million.
solid,
Yeah, it
obviously.
it grew up
But
fast. Yeah.
it's still growing. And the fact you're getting a discount in a growth market is incredibly rare. And to your point, we're actually acquiring a deal right now in Houston. It's a 506B, so I can't say too much about it, unfortunately. But to your point, the seller is actually losing $6 million on that opportunity,
Jeez.
which is really unique. You just don't see that much because we play in the
No.
150 plus unit space where these are very sophisticated institutions for as I said, for the better or worse, that's smart equity behind these deals that, hey, they basically have got very deep pockets where they can kind of bail themselves out. There's not often many forced sellers, right? And we fortunately came up in a situation where the seller was getting out of their opportunity. They had a big equity backing where they're just looking to reshuffle their deck. But we're getting a discount here where this deal should have traded for probably, a sub 5% cap rate. And we're getting this for a mid six, which is very unique in a growth market.
Yeah. And you guys are exclusively in Houston, or do you have Dallas as well?
That's a great question.
Yeah.
So we are in three markets. We're in
You
Houston,
now.
Dallas, and in San Antonio, correct?
Okay.
So just in Texas, though, so we're niched down specifically there and whatnot.
Mhm.
And for those who don't know much about Lone Star Capital, we have kind of two deal profiles. We buy, market rate deals, which is a standard down the fairway buy it, fix it, sell it play, and then also our tax abatement deals, which of course in a state like Texas with no income tax, they will get you one way or another. So mitigating that or eliminating them entirely is obviously very accretive and creates some good alpha for our investors, of course.
Awesome. Yeah. So 3 markets now. That's pretty cool. Cool stuff. So tell us what you do at Lone Star.
Yeah, absolutely. So I think I've been asked that question a lot, and I should probably put a bulletin point
Okay.
responsibility list of what I actually do. But I would say, to a certain extent, a bit of a Swiss Army knife. I'm the director of business development, which means I go on fun podcasts like this, and I, believe it or not, get to pay to talk for a living. So that's pretty cool. So I
Yeah.
go on podcasts, I host two podcasts, but I'm the guy that will call down and sort out the equity list for us one way or another, whether it be going out to find capital partners for deals, and then raising money from our own investors,
Mhm.
doing new investor calls, new partner calls, and then, of course, managing and maintaining our incredible relationships that we've currently had right now. Fortunately, I got kind of plugged into a system where it was a machine, but there was really no formal salesperson in the team, which is
Mhm.
crazy to me as a salesperson.
Yeah.
My whole life that wasn't really in there for how much success the firm's had. It was more of just kind of an Excel process. But there was, some definite low-hanging fruit, and I came in there to clean it up. And inevitably, you get to the point where you need to scale up, you need to add more systems, add more processes, and eventually hire talent who has done it, in a different capacity to kind of bring the brain trust in there. And that's kind of what I did because, as you mentioned before, or I mentioned before, I should say, I was selling homes, and you got
Yep.
to have your CRM. You basically are in a very unique situation because most people are very used to the W-2 income. This is my
Mhm.
first W-2 job, so it's kind of funny where I'm used to, eating when I
Went
kill.
backwards. Yeah.
So exactly, which is
Yeah.
really healthy though for a company. And if you're ever looking for a good employee, have someone who was an independent contractor before, because they'll realize the urgency and appreciation. If I didn't sell something, I wasn't making money, and that wasn't acceptable for me. So I kind of that internal urgency, I think, is very beneficial for the position I sit in currently.
Let's dive down that a little bit deeper. So you went
Yeah.
from commission based to a salary based, and you're talking about incentives and wanting to really, really hustle. Do you have incentives, bonuses, like performance incentives, performance bonuses built
Great
into?
question. Yeah, absolutely. So I got fortunate enough to, and this is PSA to anyone who
Mhm.
may or may not be looking to work with a new emerging sponsor or anything like that. You want to make sure that where you're going, if you get in there early enough, you have to have some sort of incentive on the back end, to
Yeah.
keep you interested in the deal. Because if for twofold, number one, keeps me kind of handcuffed for the better or worse to the firm. And then also for the employee, it keeps them, interested and engaged in the deal and wanting to do well because you want to repeat that investor. So I do get carry interest in the deal. I do get a bonus per closing. And then of course I get a salary too, which, pays the bills, but not looking to get rich on that. That's not how anyone gets wealthy in life. You
No,
want to make
nobody
sure that
nobody gets rich off of a salary.
yeah,
So yeah,
very, very few, unless you're, truly like a technician of like a surgeon. I mean, really like
yeah,
not like a
true,
technician,
true.
but like specialize in some very, very niche field where you're probably going to take some sort of a 5 to 10 year accelerated degree to get there. But by and
Yep.
large, it's really not the moat and route in which people take in order to get
Mhm.
wealthy, to your point. So, the way I looked at it, quite frankly, was if I was going to sell homes forever, yeah, you can invest in homes, this, that, and that would be a strategy. But
Yep.
ultimately, one should try to get to the principal side as quickly as possible. And I felt as if the opportunity was most aligned, worth working with Lone Star Capital to achieve that. Not to mention, too, there is an existential issue and crisis with residential real estate, which is the several lawsuits that are kind of currently underway with regards to taking away buyer side commission and stuff. So that's a
Yep.
whole can of worms there. But I just felt long term, this was a really unique
Mhm.
opportunity. And it's not every single day your best friend is also the principal and founder of a, rocket ship firm. So it was a very, very fortunate setup. And quite frankly, most people that have these positions, not to brag about myself, but probably typically come from a more of a Ivy League pedigree, have that background and acumen. He just saw me hustle in my own respective business and felt I'd be a good fit. And, just to anyone, I didn't know anything about multifamily real estate when I kind of took the plunge into it. Like I was studying, I was learning, but I didn't know anything. So I really had to learn from scratch. And I finally feel like now I really understand the business. I feel very fortunate that I got to be around the best to really absorb everything. But internally speaking, as Rob can attest, I didn't really know much before, but I knew I wanted to work and chip away at it and kind of eventually develop that skill set. And I feel very fortunate to be there now. But, anyone can pick this up.
Yep.
Obviously, having real estate background is important, but I didn't really know much about the space when I got into it, but I knew I wanted to
I'll
learn.
change my camera angle just slightly. You mentioned hustle. I would take a hustler, somebody who can hustle a ton and is smart over an Ivy League. I mean, Ivy League grads are probably smart and they probably hustle anyway. But I think the hustle is probably more important than that pedigree. And I think, yeah, you said exactly the same thing. Find somebody who's successful what they're doing and it's hustling. And oh, by the way, Streamline Capital Group is hiring right now, which is maybe a little bit of the motivation of why I'm asking you those questions about the salary and such, because I've got to figure out how to compensate people and keep them loyal.
Yeah.
So,
And where did you start buying for your firm right now? What point did you start acquiring
mhm.
and start doing that? Because I'd be very curious to know. And to help you with your process, I'll have some answers
Sweet.
for you regarding that.
So first acquisition was October. I hired two people last year. One of them I asked to leave, and the other one just recently put his 2 weeks notice in. So the previous company that I co-founded was able to, front load all the salaries and everything else. And I'm fortunate to be able to pay salaries out of pocket right now. But yeah, now I'm basically back to a company of one and, trying to rebuild and hire some new talent again.
Well, I'll say this right now. If you are interested in, giving away some of the, profit sharing on the back end once waterfall hurdles are split, guys, right now, if you're looking for a job, it could not be a better time to get into it because we all know something very rare and unique is happening, which is, as we mentioned before, is deals are at a discount right now. That doesn't happen very often. And when deals are at discounts, the market will ride up. You can catch that wave up. You're going to make so much more money in this
Oh yeah.
space at times like this, riding up this next, call it 5 to 10 year, run up when we get back to a bull market, once, things normalize.
Mhm.
Someone would be very, very intelligent and smart to pick up there. Conversely, if you are looking to get into the space and the firm's making a lot of capital calls and whatnot, or if you're an employee currently and deals are going really south, there's a lot of people leaving companies, firms, so on and so forth, because there's nothing there. Like, let's say if you're getting capital called in all these deals, you got in at the wrong point of the cycle, or you just didn't exit correctly, you're probably working for nothing. And also raising money is gonna be very challenging. So you're kind of on a sinking ship for any way you slice it. So being in and joining into a firm like yours, or if someone, not that we're hiring now, but me joining Lone Star when we did, was
Mhm.
very, very timely and it was very fortunate. So if anyone's looking to work and if they can, structure something accordingly and smart,
Oh
this is
yeah.
a golden opportunity to be buying deals, especially in the market that you're looking in. Couldn't
Mhm.
think of a better opportunity for someone who's, wisely playing the game.
Yeah. And when we talk salary structures, what you mentioned is exactly what I was offering. And I think when the last employee opted for cash instead of carried interest, that should have been a signal that maybe he's not a long-term guy. But yeah, I mean carried interest, that's the best way to do it. So you talked about being shifting gears a little bit here. You talked about being a tough environment to raise capital. I know you guys just closed a monster. It's been a couple of months, but like 600 or so units, big capital
Mhm.
raise. What are you guys doing right now to raise capital for these deals?
Yes, so we've got several channels. We've got
Cool.
institutional equity players, which are a pro and a con. And we
Mhm,
can explain all the nuances regarding equity if you'd like. We've got fund managers and co-GP partners who are somewhere between $500,000 to $2 million, I would say,
mhm,
typically speaking for equity. And then, of course, our own investors. So if let's say we have a $10 million capital stack, the most recent deal we closed on was actually Aspire Apartments in San Antonio. That was like a modest, I think, $9 million raise.
mhm,
And I think we raised about 3 million and we leveraged capital partners for the other six there. So that was
mhm.
an opportunity there where we, kind of raised a third of it and then outsourced two-thirds of it. So, I hope that answers your question.
It does, and I want to go a little bit more focused. The average listener here is probably more along the lines of a co-GP
Hmm.
or potential fund manager than institutional capital. But if you don't mind, talk to us a little bit about the difference between co-GP, fund manager,
Yeah.
and what you guys prefer coming in.
Well, I would definitely say for one to be a co-GP, naturally, if we're going to accrue and assume the risk of whatever is coming there, we got to make sure we're playing the game correctly and making sure that everyone has responsibilities and roles to adhere to what would technically make a co-GP. The other end of the spectrum is for fund managers, interestingly enough. I think it was about August of this year, and you of all people probably recall this, where fund to fund was the hottest word in the industry because so much was changing really in real time. And I got emails regarding this because I do all the outreach for our partners, when we go live with the deal and people asking, hey, do you guys do a fund to fund? Do you have a funds program, so on and so forth? And I'm like, what the heck is everyone talking about?
Yeah.
I was new to the business to a certain extent. And then also this other new little wrinkle came into play. And I was like, am I just a totally aloof or is this new? And it turns out it is in fact newer, but basically what a fund to fund manager is looking to accomplish is the same thing as a co-GP. The way you look at it, if someone is to raise equity for a deal like yours as a third party outside equity source, is they're looking to solve for, some sort of return threshold for equity brought to the deal. So let's say if, you're raising $1 million on a $10 million raise, the amount of money raised is irrelevant, I guess, for this conversation right now. But if you were to raise $1 million, hypothetically speaking, we're basically looking to solve for the what's in it for me perspective, because no one's going to raise money out of charity in good faith, right? Unless you know where they hit bodies. But with that said, typically speaking, most people are looking to solve for some sort of return back to them. If they raise $1 million, we're looking to have them make somewhere on full cycle in a deal on projected numbers. The keyword is projected numbers, somewhere between 10 to 14%. So if you raise $1 million, there's going to be something between, 100 to $140,000 returned to them full cycle, if that makes sense.
Mhm. Yep. Yeah, yeah, it does. It does. It does. Okay, yeah. So I think that's what a lot of people are doing right now. I mean, you're saying Lone Star on the last deal raised about three and you brought in roughly six from other people. It makes me feel really, really good about where I'm sitting right now because, can I get that $3 million mark? Yeah, I can hit the $3 million mark. But so would you say that that ratio is typical when you guys do deals, or if you guys are doing larger deals, are you leaning more upon the co-GPs, fund managers, or do you guys dig deep and raise more as well?
It really varies on the opportunity, I will say. And some of the issues that we do have is that since we are so focused for the better or worse, with our deals predominantly being in Houston, Texas, we would love to buy more deals in Dallas. We would love for deals to make sense in Austin, Texas. And now we're in San Antonio as a new emerging market that we're in. So that's the third market that we're in now. But, it's really hard to make deals make sense in Dallas. And a lot of people, although they love Houston, they don't want to put their whole, livelihood and net worth at stake on the risk associated with Houston due to the weather issues and just some sort of interesting zoning policies that people allude to on conversations. So I do think it's where we're seeing the best deals currently in our pipeline right now. But some people, struggle with that. But, a lot of our capital partners inbound into us because they want to work with a Houston expert because they realize the fact that there is a very large opportunity to lose money, but more importantly, looking at is an opportunity to make a bunch of money and partnering with us in Houston after going through the painstaking process of, buying markets that we want to buy in again, having, brokers we've done over $100 million of transactions with, we get the best deals and we're seeing opportunities that really make a lot of sense. Not to say we don't get good opportunities in other looks in other markets, but the numbers are substantially more compelling in the said market of Houston, seemingly than Dallas right now, at least. So hopefully that'll change at some point. But Dallas is just so competitive, it's tough. So with that said, I bet if we went live with a Dallas deal, we could probably flex up our tranche.
Mhm.
But it's also really nice to, from economies of scale and efficiency perspective, bring in new partners
Mhm.
into the fold to work with us that make it nice so we can also, do more deals and stuff. Our goal is to do about 8 to 10 deals a year and raise somewhere between $3 to $5 million a year. So if we can raise somewhere between $30 to $50 million of our own, investor money on top of, I would say, raising, from fund managers and
Yeah.
co-GP partners and institutional equity players, we're right where we want to be.
Awesome. 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 Hey, thanks for that. I appreciate that. And, I mean, from the lead sponsor perspective, there's the more money you can bring to the table, the bigger deals you can do. And, I think the co-GP or the fund manager route, if you can bring in co-GPs, you can bring in fund managers, people who are specialists at raising capital, it's going to help you to reach a lot higher. And that's
Yeah.
that's how a lot of people are doing it. That's what I'm doing. We're bringing in fund managers, we're bringing in co-GPs. And end of the day, we're trying to do exact same thing, just get higher and higher deals. So
And selfishly too, it's network effect as well, right? If we're working with really proficient and prominent capital raising partners and they post just close a deal with Lone Star, well, if they're big on LinkedIn, big on the other space, it's not that we're just trying to seep their investors, but it's just more brain space. We're just out there more. We get more exposure. So there is an immense level of value associated with working with top tier partners because if they vetted them and they're big in the space, well, then these people must be good. You know their deals must be great. Like for instance, there's a group that we just worked with on our other closing, and we talked to them for a very long time. So there's just an interesting kind of nuanced case here. But we worked with Realty Mogul on a deal, right? So
mhm,
shout out to Realty Mogul, our friends there. They're great. We love you. Hi, Kyle. Hope you're doing well. But with that said, they have a public surface and public facing company. They
mhm,
have to have a mandate to vet sponsors to go through a very rigorous process. So being allowed to be on their platform speaks to the credibility to Lone Star. And having gone through the process of, if you of all people, Brian, said, yeah, I want to raise for a Lone Star Capital deal. Well, what a vote of confidence and a flex it is for us to leverage the fact that you thought
mhm,
highly enough to us to put your name on the reputation on the line with one of our deals.
mhm.
So it's a multifaceted approach that is very creative long term. And, we're big believers of having the biggest and best network possible. And that has to do with partnerships and sharing the pie and sharing the love. And we want to build this company the right way. We're young enough guys. If for those who are watching, I'm 29. Okay. The other founder of the company, or I'm not a founder, but the two founders are Kent and Rob. Rob's 27. The other partner, Kent, is 43. But we're gonna be in the business for a very long time. So we want to build this company the correct way. Slowly is better than too quick and burning out too fast. So, whatever it looks like, whatever is most creative is what we'll do.
Yeah, awesome. And 43 to some people is still young. I'm a
I know.
little bit older than that. And I mean I'll be in plenty of time. I mean you didn't say 43 was old. You said 43 was young. I'm still saying that, but
Well, it is. It quite frankly is. Like 43 in the grand scheme of things is, you're not even at your midlife point yet, technically, right? So we are a very young firm in many respects. That doesn't mean we don't have a lot of real estate experience. And I know a lot of people in real estate, you'll appreciate this. I mean, I've been in real estate since 2016. A lot of people who've got raised in their head got into real estate a couple of years ago. So I've potentially had more exposure to real estate than they've had. It's just a little bit different. So
yeah, absolutely. Well, cool. So a couple questions to wrap things up here. First one, what's next for you?
yeah, what's next for me is just figuring out forms to enjoy my day to day to the max on a selfish perspective. So personally, we all talk about, doing this, doing that, want to make money. It's like, but at a certain point, if you just do what you're passionate about in a space like real estate, which both things happen to be true for me, the money's just going to find you. So enjoying the day to play the marathon correctly, figuring out little incremental hacks to make sure that whatever I'm doing, there's joy involved with this. Like I find this to be very joyful for me. Like talking to you right now, being on this medium, sharing, a conversation, sharing energy like this is very fun. So this is great for me.
Yeah.
Working out to start the day is great for me. So on a personal note, finding ways to enjoy the day today and
Mhm.
to stay in the game as long as possible and be healthy and happy is paramount. And then on top of that, Lone Star as a firm has an ambitious goal this year of taking down another $300 million of acquisitions. So we're about $60 million for the year right now with a deal in escrow. So hopefully by Q2, we'll be at 60 million with a couple, hopefully another, 100 million because we're behind the eight ball right now on that goal.
Mhm.
But we're looking to acquire acquire $300 million. But at the end of the day, they got to be great deals, not just good deals, because you can lose money even if you buy in this market right now. So we're very, very cautious of that at the moment.
Awesome. Yeah, so some nice goals there. I mean, I'd be happy at 60 million at the end of this year, but we just restarted again. So
60 is incredible, especially 60 starting right now. Whatnot, that's really special. So
it's restarting. It's restarting. I mean, I've been in over $100 million worth of deals, but yeah, restarting. I just got a missed call from a broker and a text saying he's got feedback on an offer. I'm just like, oh my gosh, this is awesome. That'd be a 15 million addition if we get that one. But yeah, it's exciting. I think I echo exactly what you say. It's a great time to be in real estate. Buying deals at a discount, buying at a time where, I mean, if we're not at the bottom yet, we're close enough where we can reach out and touch it.
we're
So
discovering it, that's for sure. And usually, the bottom will happen after rates get cut because this is a lagging indicator business. For those who are newer to the real estate business or are looking to get into it, just realize that it takes a very long time for these deals to trade and to be fleshed out, and for transactions to actually have to occur for us to really know what's going on and make sense of it. A lot of smart money, which owns a lot of deals, doesn't have to sell right now. So there's gonna be less trades right now. Really, it's unique if someone's actually selling right now, because we all know, smart sellers included, that it's probably not the most opportunistic time to sell. And not to mention, there was such a disproportionate amount of transactions and trades in 2021 and 2022 that since all those happened, it kind of ate up some of the transactions that are going to be happening, of course, last year and this year. So that's something to think about as well as we transpire and go through this part of the cycle.
all right. So another next question for somebody who's just getting their start in multifamily specifically, what advice would you give them?
Well, I would say be a sponge and do not chase the highest paying job. If you're looking to get a career in this, be chasing equity and management and the best team possible, because that will go farther than, maxing out whatever your theoretical pay income could be. You want everything to be back paid. You want to be underpaid now to be handsomely overpaid in the future. So strive for that.
I love that idea. And yeah, I'm essentially working for free right now for, potential big payouts later on. But that's what most people do when they're starting out. But
I drove
and
Uber every weekend, by the way, just PSA. No one's above making a buck. I was driving
yeah,
Uber from 4 p.m. to 4 a.m. Friday and Saturday every single day just to keep the real estate dream alive. So
yeah.
you got to start somewhere.
Yeah, do a little bit of hustle, get some money, but I think you're absolutely right. If you start building your future paychecks, that's how I look at each deal. You make your most money as a syndicator on the acquisition and on the disposition, right? And so every time we buy a property, I'm lining up two paychecks. I've got to live off the paycheck now, but that second paycheck, that's gravy. That's
Yeah.
lifestyle, that's inheritance, that's everything else that goes with it. So, all right, last question. How can listeners learn more about you?
Absolutely. Well, first off, thank you so much for letting me come on here and hijack an hour of your time. You can find me at Craig McGrouther, just my spelling, which is the show notes on LinkedIn, Instagram, you name it, I'm there. As well as YouTube. Rob Beardsley and myself have a weekly show where we go into the nuances, weeds, and depths of commercial real estate, specifically multifamily investing and multifamily real estate, with our little twist on it. You can hear Rob, who's a savant in the space, speak, and me interview him and ask him questions, whatever is topical at the moment. And I also do a weekly interview style podcast with fund managers, operators, and hopefully we'll get you on the show soon as well.
Awesome. That'd be great. That would be awesome. All right. So we'll put links to everything in the show notes. And if it wasn't in that bio sheet that you sent over, please send it over and we'll make sure everything gets
Will
in the
do.
Sweet. Well, hey, thanks, Craig, for coming on. Very much appreciate your time. And I haven't quite figured out the best way to say it, but my new sign off is, don't wait to buy real estate and wait. But it doesn't flow yet. So I'm just going to end it with exactly that. Don't wait to buy real estate and wait.